Today, we are going to go over our first video in our How to Buy series, qualifying. This is going to be calculating your debt to income ratio so you know, before you meet with your lender, kind of what to expect. So, first of all, your debt to income ratio is your income, your gross income, divided by your debt, plus your new mortgage payment to get your debt to income ratio. And I'll explain that here in a minute. So, in this scenario, here's our debt for this particular buyer. We've got a credit card, monthly credit card payment. This is the minimum monthly payment, is what they would calculate, is $150 for this person. They also have a car payment, which is $250. Their total debt is $400 a month. Other debts that might fall into this category would be child support, alimony, any other kind of revolving bills that are constant. Not your utilities. Your utilities will not be included. Some other things that won't be included would be cell phone bills, etc. Basically, your revolving monthly payments that you pay. Student loans would go in here if they are not deferred for more than 12 months. So that's something to keep in mind. Now your income. This particular person makes $15 per hour at 40 hours a week. So what we do is we take 15 times 40 to get us $600 per week is what they make. Now most people think $600 a week, times that by 4, get $24 a month, times that by 12, got our income. That's actually not entirely accurate because there's 52 weeks in a year, and at 12 months times 4 we only have 48 weeks, so you're kind of selling yourself short on income there. So what you want to do is take that $600 per week and multiply it by 52. That gives us a gross income. Gross income is your income before they take taxes out, of $31,200 per year. Now is where the 12 factor comes in, because we want to find out your monthly debt to income ratio. So we divide $31,200 by 12 to get $2,600 a month. Now this is where it kind of gets tricky. Depending on the type of loan program that you're using, they can use different type of debt to income ratios. So the ratio that is pretty standard in the industry is about 0.45% of your income. So your total monthly mortgage payment and all of your debt can be 0.45% of your income. Let me explain. So we take $2,600 a month. We're going to multiply that by 0.45, which is basically 45% of your income. So $2,600 times 0.45 is $1,170 per month that they will allow your total debt to be to give you a loan on your mortgage. Now it's getting kind of confusing, but it's going to come all together here real quick. So $1,170 is what we have to work with. Now we take your debt, which is $400, and subtract it from this. So we minus $400. We have $770 left for your mortgage payment. So your total monthly mortgage payment cannot exceed $770 per month. This is a great way to kind of get an idea of what you might qualify for. This $770 a month, you can go online. There's a lot of mortgage calculators that will figure out what this total debt will be for you. $770 a month, depending on the area and the tax levy rate, it's probably going to be right around $120,000 to $130,000 is what you would qualify for with today's low rates. For more on this series on how to buy a home, this is only step one. We'll have future videos coming out about every week with the processes of buying a home. Again, this is one factor. This is not your total qualifying factor. It's not based solely on debt to income ratio. You also have credit history and your actual credit score that will be a factor. Stay tuned for more.